Compound interest can make your money work for you, but the concept can be confusing. So let's walk through a couple of examples of why it's so important and how it works, especially for investors. We'll start with a story that illustrates how it works, and then we'll get into some tips for calculating compound interest on your own. Remember that examples often focus on young people starting early, but even if you're not very young, you still might benefit from compounding, and that's because you might still have several decades left of life. So don't get discouraged if you're getting a late start, and this can still improve your chances of success. So here we have 4 people who were born on the same day, and I think the most interesting ones here are Quincy and Lila, so we'll focus on them. But all 4 of these people got the exact same investment returns. They saved the same amount each month. So we're talking $200 invested a month. They all earned 5.75% on their investments, but they ended up with very different amounts at retirement age. And the difference is entirely due to compounding. So Quincy saved from age 25 to 35, and after that point, he just stopped saving money in this retirement account. Over that period, he ended up putting in a total of $24,000. Lila got started right around the time Quincy stopped. And again, $200 a month, same investment return, but she put in quite a bit more over the years because she kept saving for about 30 years versus 10. But when we look at where they both ended up, they have a very similar amount here. But Quincy didn't work quite as hard. He didn't put in nearly as much money. What happened was his money worked for him to build up that balance. Now, you can argue that it's harder to put $200 away each month when you're 25 years old, and that's a fair point. But the point of this video is to go through the concept of compounding and show you just what it can achieve. So what is compound interest? Well, it's a phenomenon, kind of like a snowball effect, where your earnings generate earnings on themselves, and that continues to grow over time and get more and more impressive. So if you make a deposit into a bank account, the bank would pay you interest on the amount you deposited. So that interest gets added to your account. Now in the next year, the next month, or whenever you earn interest, the bank is again going to pay you interest on your original deposit, but they're also going to pay interest on those interest earnings that they previously paid you. So here's an example of how that might work. Let's say you have a bank account that you deposit $1,000 in. It's paying 5%, and that is high for a bank account these days, but it's going to help illustrate the point, and you can update these numbers on your own if you want. By the way, this will be linked to in the description below, along with some other free resources for planning for your future. So this is going to pay interest each month. So in the first month, you earn $4.17. That gets added to your balance, and now the bank is going to pay you interest not just on your first $1,000, but on $1,004.17. So it's a bigger balance. Then in the next month, you earn an extra penny more, couple of pennies more. This isn't super impressive with this dollar amount, but as you have bigger amounts and longer time periods, it gets a lot more interesting. And again, this is just every month. So at the end of the year, you've made $51 here. When those earnings increase at an increasing rate, that's known as exponential growth. And if you remember from math class, that's the chart that has the curvy line going up. By the way, I'm Justin Pritchard, and I help people plan for retirement and invest for their future. Some of the things we looked at in this video are linked to in the description, so be sure to check that out. For compounding to work, you need to leave your earnings in the account so that they can continue to be invested and hopefully grow more. The concept is similar with investing in the markets for long-term growth, but of course investments in the stock market, for example, can lose money. In that case, the chart is certainly not always going to go up, and some losses can wipe out all of your gains really quickly. But you can still benefit from compounding, and it might not always be compound interest. You might get dividends credited to your account, or you might get some interest from bonds, for example. You might get capital gains distributions, but either way, if you reinvest that money, leave it in the account so that it can hopefully grow for the future, that is one way to use compounding over a long period as an investor. Just like with the bank account example, the longer the time period you have, the more impressive it's going to be. And when you look at investing in things that go up and down, there is maybe, no guarantees of course, but maybe a better chance that you can hopefully in the long term overcome any losses that you might experience. That's why it's important to invest at the right level of risk and to use a time horizon that's appropriate for long-term investments that might go up and down. So how do you calculate compound interest? It's easiest with an online calculator or a spreadsheet, but some of it you can do in your head. So we'll start out with that and then get into the calculators. The rule of 72 can help you calculate some compounding as long as you can divide by 72, and you can use a simple calculator to help with that as well. The way the rule of 72 works is it tells you how long it would take or what rate of return you would need to double your money. So we want two numbers that when you multiply them together, the product is 72. For example, if we say that you have 10 years to go, how long would it take for you to double your money? Well, we're going to multiply that by 7.2, and 10 times 7.2 equals 72, and that is the answer of how long it would take to double your money. But it works with any other number as well, as long as the result is 72. So we can do 9 times 8. Or instead of 10 times 7.2, we can say you've got 7.2 years and you need a 10% return if you want to double your money over that period. And one last example here. Let's say you think you can earn 5% on your money. So we're going to divide 72 by 5, and that tells us in 14.4 years, that's how long it would take an amount of money to double. In other words, $100,000 would turn into $200,000 over that period with that rate of return. Online calculators can also be helpful, and one of the best ones is this one from the SEC. I like it because it lets you sort of assume a range of returns. You never know exactly how much you're going to earn, so you might say maybe plus or minus my 5% is what I might get. And when you calculate it, it gives you some potential outcomes, maybe an optimistic and a pessimistic one, to go along with some estimates. Again, if you're investing money in the markets, you will almost certainly lose money at some point, and that's not something we're going to get into with this video. We're just talking about the concept of compound interest, but you can get more advanced if you want using other tools. So I hope you found that helpful. If you did, please leave a quick thumbs up. Thank you, and take care.